Welcome back. So you've got a lump sum of money that you're ready to invest, and you're not sure whether to put it all in at once or spread it out over time using a strategy called dollar cost averaging. Well, you're not alone. This is one of the most frequent questions friends, family, and strangers keep asking me, and it's time I address this in a video. I'll help you weigh all the pros and cons of both options and decide which one is right for you. And then towards the end, I'll give you my own personal recommendation that I tell my friends and family. I'll also offer some tips once you've decided which method to use, and we'll look at some actual examples comparing the two methods during the housing crisis. Now, first of all, most people don't have a big lump sum of money to invest all at once. That's why I have a video on all the surprising benefits of dollar cost averaging. Most people should just focus on saving and investing each month and never care whether the market is going up or down. Just build the habit of saving and investing and stick with it through thick and thin. If you are never posed with a dilemma on how to invest a larger sum of money, then dollar cost averaging is absolutely the method of choice. But let's say you were lucky enough to come into a bunch of money and you want to be responsible and invest it. Maybe you had an inheritance, a big company bonus, sold some real estate, received some life insurance, or maybe even won the lottery. Even when we have made the choice to invest it into the market, it can feel scary, and we may not be confident about which method might be best. The main difference between dollar cost averaging and lump sum investing is when you invest it. With dollar cost averaging, you invest small amounts of your money at certain intervals over the course of time. Lump sum investing, on the other hand, is when you take the money you have to invest at that moment and invest it all at once. How about an analogy? Let's say you want to go swimming in a beautiful lake. Are you the type of person that wades in slowly, or do you jump in all at once? Now, you might know what you would do in that situation, but we might want to base our financial decisions using a more thoughtful approach. Now, let's start with lump sum investing. This approach involves putting all of your money to work all at once. Some investors swear by this method, claiming that it maximizes returns and minimizes risk. And honestly, the evidence suggests that lump sum investing is generally better than dollar cost averaging, especially when you have a long-term investment horizon. Vangaurd did a study published in 2012, linked below, where they looked at 10-year investment periods and compared lump sum investing to investing in increments over a variety of different periods. In fact, they looked at 1,021 periods just using a 12-month dollar cost averaging method. They found that lump sum investing won out about 2/3 of the time. And it didn't matter where we were investing our money, whether it was 100% stocks, a 60-40 stock bond split, or 100% bonds. Lump sum investing won out about 2/3 of the time. Another study done by Northwestern Mutual, also linked below, looked at 10-year returns and compared investing money immediately versus the dollar cost averaging method, where the money was invested evenly over 12 months. The results show that investing all at once won out over dollar cost averaging at least 75% of the time. Again, regardless of asset allocation. These results really shouldn't surprise us that much. After all, the S&P 500 had positive returns 19 out of the past 25 years, or 76% of the time. How about during the past 65 years? Well, the S&P 500 went up about 72% of the time. And if we are in a year where the market tends to go up, then the sooner we invest, the better we are likely to do. So there's the math and the probabilities for lump sum winning out over dollar cost averaging. But if we would have been making this decision early in 2008 during the housing crisis, we would have probably been kicking ourselves for investing all at once. So this debate isn't settled yet, because putting all of our money into the market all at once can be nerve-wracking, especially if the markets take a turn for the worse shortly after your investment. This is where dollar cost averaging comes in. With this strategy, you invest a fixed amount of money at regular intervals regardless of market conditions. While statistically dollar cost averaging may not generate the same level of returns as lump sum investing, it can provide a sense of security and peace of mind. You know you're investing the same amount every month, and you're less likely to panic if the market takes a dip. So by taking a slow and steady approach, you may be able to invest with less emotions. If you have a lower risk tolerance, dollar cost averaging might be the right choice for you so you can sleep better at night. This is especially true, I think, as the amount we are investing increases. For example, I think the emotions involved with trying to decide to invest $10,000 all at once is much different than trying to decide whether to invest $100,000 all at once. As the amount we currently have to invest increases, so does the emotions associated with it, even though, logically, the decisions should be the same. And it's always silly to try and pick the top or bottom of a market. So why make a big bet on the market by putting all that money to work at once? What many investors don't realize is that they are, in fact, making a market call when they're doing dollar cost averaging. They are betting that the stock market will go down for a while and then come back up later. Logic based on data tells us we should just lump sum invest it. But if dollar cost averaging helps you sleep better, that may be the best choice for you. So a quick summary, and then I'll give you my personal recommendation that I tell friends and family. Lump sum investing historically has generated slightly higher returns more often. When markets go up, and in any given year they go up around 70 to 75% of the time, you're able to take full advantage of that growth. However, you may regret that decision if you experience market losses very soon after investing. Dollar cost averaging helps remove some of the emotions of investing and lowers our stress levels. However, it tends to underperform relative to going all in at once. If you're willing to take on more risks and you're in it for the long haul, lump sum investing may be the way to go. But if you prefer a more cautious approach and you want to avoid emotional decision making, dollar cost averaging could be a better fit for you. There is no perfect answer, and no one can know for sure which method would be best in any particular year. But here's a few things to keep in mind. If you dollar cost average, it requires discipline to commit to a plan because it can open the door to behavioral mistakes. Make a decision to buy at regular intervals, regardless of what the market is doing, and stick to it. The second point is, if you dollar cost average, don't spread it out longer than 12 months. Shorter is fine, but studies have shown that if we go beyond 12 months, dollar cost average performance measured against lump sum investing actually gets worse. The third tip is, if you dollar cost average, there's cash sitting there waiting for you to invest it. And this can be tempting for some people. You must view that money as off limits. Do not spend any of it on something you may want. The fourth tip is, it's probably best not to try and pick individual stocks. Stick with a low-cost, passively managed ETF. Something similar to an ETF for the S&P 500 would be a great choice for most people. The fifth tip, use a discount broker. There's probably no reason to be paying unnecessary fees associated with mutual funds, especially like front-loaded mutual funds. There's no sense losing money right out of the gate when we invest into loaded mutual funds. Finally, the sixth tip. Whichever method you choose, stick to it and don't look back and second guess yourself. After you have made your choice, try not to care about what the market is doing over the course of the next year. Feel comfortable knowing that several years from now, the market will be higher and you'll be very glad you made the investments you did. Now, how do I answer this question for my friends and family? Well, I do try and explain some of the facts that I've laid out in this video and let them know that lump sum investing is better approximately 65 to 75% of the time. But I also understand the emotions they may experience with that decision. So I take a middle of the road approach with my recommendations for others. I usually suggest that maybe they consider putting 50% in right now, all at once, then 25% 3 months later, and the last 25% 3 months after that. Ultimately, the decision must be theirs, and they should weigh their options and make a decision they are comfortable with. Of course, in a particularly bad year for the market, dollar cost averaging can still win out, even though lump sum investing is usually better. Let's look at the worst year in the S&P 500 since 1931. In 2008, during the housing crisis, the S&P dropped 37%. That's clearly one year where dollar cost averaging has a big advantage. If we had invested $10,000 at the beginning of 2008 into an ETF for the S&P 500, lump sum investing would have grown into approximately $18,600 10 years later. If we had invested 50%, then 25% in 3 months and 25% in 3 months after that, it would have grown into around $19,700. However, dollar cost averaging over the full 12 months would have grown into around $22,200. This just happens to be one of the best years we could have used to see an example where dollar cost averaging wins out over lump sum investing, because the market dropped 37% that year, and that's the biggest drop since 1931. Keep in mind though, that in the past 65 years, the market has gone up 72% of those years, and lump sum investing wins out about 2/3 of the time. I hope this video has been helpful in allowing you to make a more informed decision about how to invest a lump sum of money. If you have questions or comments, feel free to leave them below. And if you find this video helpful, please hit the like button and subscribe to the channel for more content like this. Thank you for watching.
Makes sense, but I don't understand why.
Well, what I meant was, in what I was quoting earlier is for compared to like dollar cost averaging against 12, spreading it out over 12 months. Remember, lump sum investing won about 66% of the time in those studies. And so, but if we go beyond 12 months, like if we dollar cost average in over 2 years, actually then lump sum investing wins out even more often.